Hello, welcome to the Money and Markets podcast, the podcast where we break down complex financial topics into simple, actionable advice. I'm Kuzanai Sharara, and today we are diving into a crucial topic for everyday investor, that is that of understanding risk management. Whether you're a seasoned trader or just starting out, managing risk is key to long-term success in the stock market. So let's get started. First thing first, what exactly is risk management? In simple terms, it's the process of identifying, assessing, and controlling potential losses in your investments. Think of it as a safety net. The stock market is unpredictable, and even the best performing stock can take a hit. We are seeing that on both the Zimbabwe Stock Exchange and the Victoria Falls Stock Exchange. So risk management ensures that you are prepared for the ups and downs so you don't lose more than you can afford. That's very important. You don't need to lose more than you can afford. Otherwise, it will be a disaster. So why risk management is important? Now, here's the thing. The stock market is inherently risky. Prices fluctuate daily due to factors like economic data, company performance, and even global events. Without a risk management strategy, you could end up making emotional decisions like panic selling during a market dip that hurts your portfolio in the long run. Risk management helps you stay disciplined, protect your capital, and sleep better at night, knowing you have planned for the unexpected. So let's now talk about strategies of risk management that you can use to manage risk. One of them is diversification. Don't put all your eggs in one basket. Spread your investments across different sectors or different asset classes and even geographies like investing in other countries. This way, if one investment underperforms, others can balance it out. Another strategy is position sizing. Never invest more than you can afford to lose in a single stock. A common rule of thumb is to limit any single position to 2 or 5% of your total portfolio. Stop loss orders. This is a preset order to sell a stock if it drops to a certain price. It helps you limit losses and avoid emotional decision making. And then the other one is risk reward ratio. Before entering a trade, assess the potential reward relative to the risk. A good rule is to aim for a risk ratio of 1:2, meaning for every dollar you risk, you aim to make 2. Stay informed. That's the other strategy. Keep up with market news, company earnings, and economic trends. The more informed you are, the better equipped you will be to anticipate risks. Now let's talk about common mistakes to avoid. Now, even with a solid risk management plan, investors often make mistakes. Here are a few mistakes to watch out for. 1. Overtrading. Buying and selling too frequently can lead to higher costs and increased risk. Stick to your strategy. And then ignoring market conditions. What works in a bull market might not work in a bear market. Adjust your risk management approach based on the current environment. Number 3, letting emotions drive decisions. Fear and greed are your worst enemies. Stick to your plan even when the market gets volatile. Now, maybe let me share my final thoughts on this issue of risk management. Risk management isn't about avoiding risk altogether. It's about managing it wisely. The goal is to protect your capital while still giving your investments room to grow. Remember, even in the most successful investors experience losses. The likes of Warren Buffett, they experience losses. What sets them apart is their ability to manage those losses and stay focused on their long-term goals. So take the time to build a risk management strategy that works for you. Your future self will obviously thank you. That's it for today's episode of the Money and Markets podcast. If you find this helpful, don't forget to subscribe and share with fellow investors. Until next time, happy investing, and remember, stay informed, stay disciplined, and always manage your risk. This is Kuzanai Sharara signing off.